In this video, I'm going to talk about business documents. Okay? And if you can still recall your accounting concepts and principle, there is a concept called objectivity or verifiability, which states that business documents should be supported by evidences. And these business documents here are the evidences. Okay? Before I start, let me just mention that the definitions that I will give here are based from FABM books and not from the Bureau of Internal Revenue, because there are differences. Okay, so first we have the purchase order. This document is issued by the buyer to the seller. Okay, and this is issued to signify purchase. Okay, so the buyer issuing the purchase order is like telling the seller that I want to purchase the following goods. Okay, this also gives the seller the rights to deliver the ordered goods to the buyer's place. Okay, and after issuing this document, both parties don't have to record yet, so here no recording. Okay, so that's for purchase order. Next, we have the sales order. Okay, so after the seller received the purchase order from the buyer, the seller prepares this document, the sales order. The seller will fill this out. This is an internal document to be filled out by the seller and then sends it to the buyer. Okay, so seller to buyer. And the reason for forwarding of document is to confirm or to approve the sale of goods before they are delivered or received by the buyer. And this is also sent to double check with the buyer the goods he or she intended to purchase from the seller. Okay, and same with the purchase order, no parties will record upon issuing this document, so no recording. Next is the delivery receipt. This is from the seller to the buyer, and this is signed by the buyer to confirm that the goods have been delivered or received by the buyer. And because of lack of information in this document, it still won't allow us to journalize, so no recording. Then we have the sales invoice. This is sent by the seller to the buyer to indicate account or credit sales. And this is the time where both parties will record. For the seller, it's sales on account. Journal entry is debit accounts receivable, credit sales, and credit output tax. For the buyer, it's purchases on account. Journal entry is debit purchases, debit input tax, and credit accounts payable. By the way, this is called purchase invoice on the buyer's hand, but basically it's the same document. Then we have the debit memo and the credit memo. Both of them apply to returns and allowances. Debit memo is issued by the buyer to the seller, while credit memo is issued by the seller to the buyer. The first one is called the debit memo because the buyer here debits his or her accounts payable to the seller whenever there are returns and allowances. To illustrate, the entry of the buyer here would be debit accounts payable, credit purchase returns and allowances, and credit input tax. The debit to accounts payable here is the reason for the name, okay? And the other name for debit memo is debit note or debit memorandum. And then for the credit memo, it is called the credit memo because the seller here credits his or her accounts receivable from the buyer whenever there are returns and allowances. The entry of the seller for the returns and allowances would be debit sales returns and allowances, debit output tax, and credit accounts receivable. And the credit to AR here is the reason for the name credit memo. And the other name for credit memo is credit note or credit memorandum. And then we have the official receipt. This is issued by the seller to the buyer whenever the seller collects cash from the buyer. So bottom line, cash collections or debit to cash. And then we have the cash or check voucher. This is for authorization of payment. So you will have to fill out this document and then you attach documents that require payment, for example, the invoice. And if approved, you will get the cash or check. Bottom line, this is for cash payments or credit to cash. And that's it for this video. Thank you.